Hey guys, welcome to the Commercial Cash Flow Show. Today we're talking about how to finance your multifamily real estate transaction. We'll be right back after this commercial break.
Propelio TV is sponsored by Noble Mortgage and Investments, Batchgate Tracing, Think Multifamily, CreativeCashflow.com, and Lifeonaire.
All right, welcome.
No.
Okay, welcome back to the Commercial Cash Flow Show. I'm your host, Ronny Phillip with Kingly Acquisitions. I'm here with my co-host, Kenny Wolfe with Wolfe Investments, and today's guest is Anton Mattli with Peak Multifamily Funding. Welcome to the show.
Yeah, thanks for having me. It's great to be here.
Thanks, Anton. Good to see you.
So today we're going to talk about how to finance your multifamily deals. So we have an expert here in multifamily. And kind of give us an introduction of how you got started in this industry, because I think that's important.
Sure,
for people
would
to know.
love to. As you can hear, I wasn't born in East Texas. I'm from Switzerland originally, and in Switzerland a lot of people, they are into watches and engineering and finance, and I happened to go to school for finance. After I graduated, I joined UBS, which is a major investment bank, worked with them in New York, in Tokyo, and Hong Kong. And after that, I left banking and started to do direct investments on behalf of family offices, which are large, wealthy families, including commercial real estate. And that was bringing me back to the US. Roughly 15 years ago, and we started to invest in commercial real estate, including multifamily. Me personally and our family, we have been investing in multifamily for more than 25 years now.
Okay.
And on the financing side, I've been doing it for the same amount of time, right? So I have been embedded in multifamily and the financing part for a long time, including also some of the downturns.
Right. Well, that's interesting because a lot of the folks that we've talked to that we know got started after this last,
Right.
the great, recession. So that's good to have someone that's actually been through a few cycles now. So can I jump in real quick here?
Sure.
So how do you, so the folks that were buying in say 2006, 2007 before the Great Recession, who are the folks that survived and how did they survive?
The ones that survived were a couple of them, right? The ones that had very low leverage, obviously they were able to survive regardless of what the situation looked like. The ones that also survived, even if they had a higher leverage, were the ones that didn't have to refinancing from 2008 to 2010, right?
Right.
Essentially, we had, roughly speaking, 2 years when the liquidity just dried up. It was very difficult to get the financing. Cap rates jumped up quite a bit, so the valuation came down. So even if you had a property that was cash flowing during that time,
Right.
it was still impossible at that point to get to the valuation in order to get the refinancing done. Right?
Gotcha.
So that was, I would say, one of the key elements where not having to refinancing during that time, or then having a very low leverage to start out initially.
So the guys who wrote it through, though, I mean, the folks that were, I guess, behaved well
Yes.
during all that. Now that they're like, say, they sold maybe 5 years after the recession, the Great Recession. I mean, what kind of returns? Were you seeing those folks get?
Yeah, the valuations really for most of them, they came back within 3 years,
Right.
To where they started out. Obviously, there were some exceptions there, but after 4 or 5 years, typically their returns were still obviously not as great as what we have been seeing over the last 8 years, but they were still in the upper single digits. Right,
Okay.
so as long as you were able to get through that 2.5 year period, you were in good shape.
Okay. Good.
And talk about like during the recession, like you say all the liquidity dried up. What did that actually look like? Because when it was a recession, I was in 8th grade, so I had no clue we're in a recession. So just being transparent here. But what did that actually look like for people that are new to multifamily investing? Because I'm not sure if an event like that, like a banking failure, will happen ever in our lifetime again with all the new restrictions and regulations and stuff. So.
Yeah, let's hope it's not going to happen again. Certainly the risk is smaller now than it was then, right? But to be fair, we also had in the late 90s, we had a financial crisis, right, which was called the Asian crisis, but it really contaminated the whole world to some extent. And in 2008, the impact was much bigger because of the single family meltdown, right? On the commercial side, the financing structure was very different. There was much more. It was much more driven by securitized loans, by CMBS loans. So agency loans and bank loans were a much smaller part than they are today, and that was really where the impact was the greatest. But when you had more than 50% of all the multifamily financing done with these collateralized mortgage-backed securities, and everyone stopped. It virtually came to a halt, right? So you have more than 50% of what you were able to finance half a year earlier completely disappeared, right? Yeah. So that dries up the liquidity completely. So whoever was left, when we look on the banking side, the banks had trouble too, right? So they had to go to the government, had to apply for some assistance, so they were not willing to lend. So at some point, the only ones that were really still kind of forced to lend were the government agencies, right? But not every loan really fit into that. And as we discussed before, if your valuation was just not high enough to support that refinancing, you just weren't able to refinance at that point.
And you're stuck.
So the situation was pretty severe for anyone, even if you were in a financial good position, unless you were able to inject equity at that point. The situation was very severe for virtually everyone for that roughly 2-year period.
Right.
And you touched on low leverage. What exactly is low leverage for people that don't know?
In multifamily, and we can touch on that a little bit later, one of the advantages is that you can get up to 80% leverage of your purchase price, sometimes even of your cost, including rehab money and closing costs. But when we look at the average leverage that even back then was in place on the agency loans, it was around 65%, right? So it was not really that high of a leverage. But if you were above that, let's say 70, 75, all the way to 80, you certainly were suffering the most if you had to refinance at that point, because valuations came down during that 2-year period by typically 20 to 25%, right? It was a big drop, but it moved up very quickly. But if you have to refinance right at the bottom and the valuations temporarily are off by 20 plus percent, there is just no way to do it if you have an 80% leverage. If you had a 65 to start out originally, you still had enough of a cushion that you still could do the refinancing.
Right. And so I personally expect this next, kind of dip recession to be a lot less severe. Mm-hmm. So since you've been over 25 years, was there like kind of a softer recession, and what did that look like on the lending side?
Yeah, so it's in the U.S. 2001 was much softer, right? So there the rents on the multifamily side really dropped very slightly during that time, and they recovered with virtually less than a year. Right? Okay. So the impact there was very minimal, really. Right? Okay. Particularly if you talk about a 5-year plus hold, it was just a blip on the horizon, really. Right. And the valuations didn't drop nearly as much during that time too.
Okay. That's good to know, because I think this next recession is going to be similar to that, where we're going to see kind of a slowdown for 12 months, maybe less, but then bounce back kind of to
Yes. So let's hope that is happening. Obviously, we just don't know.
No, and no one knows kind of when when that's going to happen, or
Yes.
otherwise we probably wouldn't be here.
That's exactly right.
So, well, okay, so good. That's good. Should we jump into the slides now?
Yeah. So let's talk about like an introduction to multifamily financing and how to get started if you're a new deal sponsor and what to really look out for.
Yes, certainly. I think a lot of our audience has already experience on the single family side, right? So I thought that it's worthwhile to touch a little bit on that, right? And how that compares with multifamily financing. So one thing that is great on the single family side, I think, is that you can get 15-year to 30-year fixed loans that are fully amortizing.
Right.
On the multifamily side, which is really similar to commercial loans in general, generally you have loan terms that are 5 to maybe 12 years, sometimes a little bit more. When you look at that chart, you have available terms all the way from 3 to 40 years. The 40 years are really kind of a niche, which are the HUD loans.
Right.
For the typical investor, particularly new investor, these are not really the loans that you typically can go to. So you have to look at that 5 to 12 years and compare it with the 15 to 30, what you typically have on the single family side. Obviously not the hard money loans to flip a house, but actually a loan for a long-term investment.
So also too on there, we should, I guess the next slide tells about
Yes.
it. So talk about the amortization. So
yes, that's right. So now the interesting part is, right, it's not just a term of 12 years and it has to amortize over that period. Right. So essentially, with the single family, as we all know, it's 15 years or 30 years and it amortizes over that period. Now with multifamily loans, if it's a bank loan, they amortize typically 20, 25 years, even though the loan may be just 5 years, and then you have a balloon payment. With an agency loan like Freddie and Fannie, just for those of you who have heard Fannie and Freddie on the single family side, that is something that obviously they are massive finance organization for single family homes, but they're also playing a massive part, particularly after the downturn on the multifamily side, right? So both of these agencies, they finance on a yearly basis 35 billion plus each in multifamily loans every year, right? So what is important is to understand, and that's why it's highlighted on that slide, is that there is a balloon payment at the end of the term, right? Either you have to refinance at that point, or then you have to sell the property, right? And that's what I was referring to earlier in 2008, 9, and 10. If you had the balloon payment and you had to refinance, that was not a zero amount, right? So you still had a pretty significant number that you had to refinance at that point.
Right. Yeah.
And touch on why are the multifamily loans shorter versus getting a 30-year loan on an apartment? Like, why is that not a possibility?
Yes, it's a very good question. I don't think that anyone is really having a clear answer to that, other than that the market is really defining it, right? With single family, everyone assumes that you have, or at least the traditional way of looking at single family, not as an investor loan, is you buy a property and you're in that property for life, right? Even though it's not really the case, but that's the theory behind it. Whereas with commercial properties, including multifamily properties, the average hold time for multifamily over a longer period of time is around 7 years in most markets, right? So why would a lender provide 15-year, 20-year, 30-year loans when it typically is being sold anyhow after an average 7 years? So the market has kind of adjusted to that need that the investors have.
Right. And it's also probably the much larger dollar amount too, right? I mean, that's a lot more money to be fixed at.
Oh, absolutely.
At that certain rate. So
yeah,
that probably has something to do with it too.
That is only also an element there. Leverage, you do not get as high leverage-wise as on the single-family side with some of the programs that you have, like FHA loans and VA loans, right, which are kind of a very attractive financing portion on the single-family side, particularly when you're starting out, right, or if you're a service member. But compared to other commercial real estate, multifamily is actually very attractive from a leverage perspective. Right? When you look at office buildings, retail buildings, if you can get to 75% of leverage, that's actually pretty good. Right? On the multifamily side, it's relatively easy to get to 80% as long as the debt service coverage can support it. And we can talk about that a little bit later, but that's the only constraint. But as long as the cash flow of the property is really good, you can get all the way to 80%, not just of the purchase price, but with a Fannie loan, for example, including rehab and closing cost. So that's really attractive, much more attractive than any other commercial asset class.
Right. Yeah, I mean, so we have, we do multifamily, but we also do some commercial as well. So we bought some commercial single-tenant properties, and yeah, I mean, the our amortization is 25 years. You know, at a max, I can't push them anymore. I've asked so many people to get us better terms on that, but we're stuck at 25 on a 25-year amortization. So we're building up a lot more equity faster, but we're not as good as it's not as cash flow a heavy deal. And then multifamily, yeah, I mean, we're seeing obviously the 80%. We're about to close a loan tomorrow. And then this is a non-recourse bridge loan, and we could probably talk about that down here in a little bit. But we got 78% of purchase and 100% of rehab. So you're seeing some of those loans too now. It has to be specific to a property, and you got to have a good story as to why it can cover all that. And you have to buy it cheap enough for it to cover all that, for the cash flow and all that. But yeah, we're seeing some great, and then low interest rates as well. On that, so
definitely, another great story about multifamily investing compared to single family, and I think that's one, if you are coming from single family and are considering multifamily, this in my view is one of the most important pieces that you need to understand, right? It's, I call it the power of stacking of net worth and reusing that net worth over and over, right? If you come from the single family world, everything is driven by your DTI, your debt to income ratio, right? Your personal one, right? Yes, your rental properties, after you have to season them for 6 months, or in a worst case, 12 months, the lender is counting that as your income, personal income stream, and that improves your income, so you have a higher ability to borrow money, right? But it's still your overall personal income that is really counting, and you cannot go above that, right? So you're constantly restricted by your DTI, right? When it comes to multifamily property, the cash flow of the property is really what drives the underwriting of the loan, and not your personal cash flow, right? What still matters is that you need to bring net worth to the table and you need to bring liquidity to the table, but the advantage is that if you do not have enough, Kenny, right, you can talk to Ronny or whoever else you know and say, look, I need some additional net worth and or liquidity so that we can purchase that deal. Would you be willing to partner with me, right? And a lot of the transactions that we see are done exactly that way. It's not unusual that you have 2, 3, sometimes 5+ co-sponsors together that partner up for the expertise as well as for the net worth that they need and the liquidity that they need. Right?
Yeah, we just talked about that last show. Is that it's all this is multifamily is such a team sport. Not just for finding the asset and managing after post close, but it's also getting the loan. I mean, you got to team up because these are. The loan we're closing tomorrow is almost $13 million, and so so there's 3 of us on the to sign on the loan on that deal. But at the same time, what's funny is it's easier for me to get a $12.9 million loan than it is to refinance my own house. That's crazy. That's how it goes.
That's the crazy part, right? Particularly if you also do not have a W-2, right? It's much more challenging to get that.
Right.
So it's kind of crazy, right? The other great part about it is, like, you do that deal for $30 million, you close that deal, and you can go and do the next deal because your net worth is still usable for the next deal, right? Obviously, liquidity not so much, right? Because you had to invest in that deal, but your net worth can be reused and reused over and over.
Yeah, and a good example is, so tomorrow we're closing 309 units in El Paso on a multifamily loan, and then April 30th we're closing a $14.5 million loan.
Yeah.
So 10 days later, we're doing triple done, and then $14.5 million loans, and it's non-recourse, and we can hit that button, like you said, as many times we want.
Yeah, right.
On the multifamily side, because it's non-recourse and it doesn't, we're not constrained by our personal debt to income ratio.
Right,
It's more about the property at that level.
Yes,
So that's the power of multifamily right there. And also they're non-recourse. Most of our loans. So.
That's another important part, right?
I'm probably skipping ahead, but go ahead.
No, that's okay. That's only a very important part. So just quickly jumping through this slide, we don't have to go into too much detail, right? But obviously, floating and fixed interest rate, you have that available both on the single family and on the multifamily side. Interest only, other than the rehab loans, the short-term rehab loans, is not really available typically on the single family. Maybe a little bit more now, right, with the market heating up a little bit more. On the multifamily side, that's really something that is very common. I would say the majority of multifamily loans we do have at least 1 year of interest only, right? Very often, if it's a lower leverage, like a 65 leverage loan, it's not uncommon to have 5 years plus of interest only, right?
Wow.
And even if it's, let's say, a 75 to 80% leverage, as long as the cash flow is good, the sponsors are good, you may still get 2 to 3 years of interest only, right? Very attractive, particularly when you buy a value-add property that doesn't have the immediate cash flow, right? So it kind of helps you to get over the first 1 or 2 years until you can crank up the cash flow.
Right.
One of the negative elements of multifamily and commercial real estate, really, it doesn't matter whether it's multifamily, office, triple nets, and so on, is the prepayment penalty, right? That's one of the beauties about single family loans. You have that 15-year or 30-year mortgage. You buy the property today, and next month you decide, oh, someone is offering me $100,000 more, let's sell it. You can sell it, and you don't have essentially any cost other than the title cost and all the closing cost, but no prepayment penalty by the lender, right? You don't have that on the commercial side, right? You have it whether it's multifamily or anything else. You have so-called yield maintenance, where you have to keep the lender whole. But you also have, with agency loans, at least an option to get a so-called step-down prepayment penalty, which starts out, as an example, for a 10-year loan at 5% for the first 2 years, and then it drops to 4% the next 2 years, all the way down to 1%. It's relatively hefty compared to single family, but at least you know what you're getting, right? With other commercial loans, it's typically always yield maintenance if it's a non-recourse loan. So that's another benefit that you have on the multifamily side. The only lenders that kind of are willing to go with that step down and very low prepayment penalty on the multifamily side are banks, but also their long terms are usually 3 to 5 years. Right? Non-recourse is a big piece, right? And you mentioned that before. You don't have that on the single family side, right? So you're always on the hook personally. Now, once you get into the commercial space, right, and you mentioned a $30 million loan, a $30 million transaction, $40 million transaction, at some point, if you have to guarantee it and personally be liable, you hit the ceiling of what the lender is comfortable with you, with your contingent liabilities, as we call it, right? So even though you do not are liable, you are not liable right now, you are potentially liable, right? And at some point, the lender will say, well, you already have 30 million that you have personally guaranteed. I think you have reached your borrowing capacity, right? With a non-recourse loan, you don't have that, right? So you could go on and on and on up to several $100 million of non-recourse loan, and you will never have that restriction, right? So it's a beautiful thing, and that's really how a lot of syndicators like you have been able to grow the portfolio.
Right. I tell folks we're on the non-Dave Ramsey plan. So I think I've signed about $200 million worth of non-recourse loans. And I sleep very well at night. So I hope Dave is watching.
Yes. So as long as you do it right, that is your friend. Right. Yeah. Obviously, if you do it wrong, then that can become your enemy there too. Right. Yeah. And there is no doubt that some sponsors out there probably overextend themselves and are going to have problems. But if you do it right, you have that cushion that will allow you to get through that 2-year or 3-year period that we have talked about. Right.
Yeah. Okay. Well, good, guys. Stay tuned. We're about to go to a break, but please comment, share, get your questions kind of queued up so we can answer those at the end of the show. Thanks.
The Propelio Academy, an all-in-one education resource for training in wholesales, subject to wraps, short sales, flips, rentals, BRRRR, property management, and more. Go to propelio.com/academy to get your scholarship today. Propelio.com. What does Propelio offer? Lead generating websites, access to true MLS comps, off-market lead lists, and deal alerts. Get them all today at propelio.com.
Welcome back to the Commercial Cash Flow Show. So we're talking about multifamily financing. So Anton, you mentioned, deal sponsors. Like, one thing I want the audience to understand is there are certain risks involved in multifamily, and how do you avoid being over leveraged? Because I see it a lot. I see a lot of deal sponsors just getting very, very high leverage with some bad deals. So I just wanted you to dive in on what to look out for, especially when you're a new deal sponsor. I think conservative underwriting and low leverage is key right now.
Yes. Obviously, low leverage is always your friend when you have an issue, right? But let's say you target at 80% or 75 to 80% leverage. What you have to look for when you are an investor, or even if you co-sponsor with someone, is really to look at how is that underwriting done? Does that make sense, right? Or the comps that are being used, do they make sense, right? It's fine to project a $100 rent bump, but are the comps that have been used, are they really comparable, right? Or have they just come up with some good reasons why they could do it? For example, I saw not one in Dallas, but in Alabama, that was a deal where they had a C-class property in an excellent location, but they actually compared it to A-class properties next door, right? So naturally, yes, the rents were $400 higher, but it would be insane to think that you could jump it by 300, even 200. Right. So maybe the rent bump was probably maybe 75 to 100, right? So I think that is important, that the sponsors really understand how to underwrite the income side as well as the expense side, right? And at the same time, not to be too aggressive on the rent growth and underestimate the expense inflation.
Okay, that makes sense. And Kenny, how are you underwriting deals right now whenever you're
So we're padding we tend to pad a few spots on our underwriting tools. So that would be the biggest three I would say that we use are the rent increases, and especially going in the future. You know, we're assuming 2% in most of our deals, and we've done that for a while now. But that the economic vacancy, that's a big number we usually pad.
Yeah.
So like markets like we're in Oklahoma City, a deal we bought in Cleveland. You know, when we underwrite, we're considering it stabilized at 12% under underwriting tool. Do I think we're going to hit 12%? No, I think we're going to get lower than that. That's our goal, right? But you still have to underwrite with that cushion in there, that economic vacancy. And then expenses too, you usually over budget for that. Try to come in and find a place where we can make that more efficient, but underwriting inflate that. And then I guess the final thing would be the reversion cap rate. So when we go to sell this, I usually add at least a half point to what they're going for today, at least, depending on the market.
Yeah.
So those are the places that we underwrite more conservative. I see a lot of folks underwriting. I mean, I was pitched a deal in the Carolinas, and they wanted to help raise money for it. Their reversion cap rate was 5.5.
Wow.
I was like, not only no, but heck no. Am I going to raise that? Good luck. I wish you the best. And it was a B-class property. But do I think you're going to be able to sell this in 5 years at a 5.5 cap? I think that's risky. Sure. And that number that reversion cap rate, even a quarter or a half point difference can really move your numbers. It can move a deal that makes. I looked at a deal we underwrote the other day. If I, was more aggressive on the reversion cap rate, it turned this what would be a 7% total return over 5 years, to 100%. If I got more, if I really pushed the envelope on that cap rate, so that's a big deal, that reversion cap rate.
Yeah,
you got to be careful there, and obviously everywhere else as well. But yeah, I mean, now's not the time to be assuming 3 to 6% rent growth from here on out. We've had that for the past 6 years or something like that in DFW. So now's the time to back off a little bit on that. There's still deals out there. You just have to look at them, look for them. Sure. Dig them up. Most of the deals, the 4 deals we will have closed in 2 weeks since Christmas, multifamily, they were all off-market deals. So either 3 of them were true, or one was truly off-market, where just me and the seller made and the transaction, and the other 3 there were 4 or 5 of us deal sponsors that were looking at it at the deal, and that was it. So those are the deals we're looking at pretty hard at today. The stuff on the market, not so excited about. We look at it just to keep contact with the brokers, and some of them make sense, some of them can make sense. But so far we've had more success on the past 4 months on the off-market and truly off-market deals. So
yeah, good. So you mentioned economic vacancy. Just wanted to jump in here quickly, right? That's another element where we see a lot of errors, particularly in year 1 and year 2. People do not really understand when you have a value-add property and you say you're going to raise the rent through rehab by $100 plus. It has an impact, obviously, on your physical occupancy, right? But it also has a big impact potentially on your economic vacancy too, right? When you have to re-tenant the property, hopefully with better tenants, with higher paying tenants, very often your economic vacancy can increase quite a bit during that period, right? Also, I think a lot of new sponsors do not really properly account for the timeline to do all these rehabs, right? You cannot just say, well, we raised the rents by $100. Well, maybe you're able to do it, but it's not happening on day 1. Right? So
no, and maybe only 50% in that first year, because average turnover on a multifamily deal is 50%. Yeah. So if you assume 100% in year 1 that you're going to turn all these units, good luck. I mean, I just don't, unless you just new sheriff in town. I mean, that's and kick everybody out.
That's right.
It's probably not going to happen. So even 50% sometimes is pushing it. So,
sure.
So I totally agree on that.
What's the typical ratio you see whenever you're taking over a property? Like, how long has it taken you to pretty much say you're the new sheriff in town and start actually turning those older classic units into the more renovated on your game plan?
Well, you do the whole new sheriff in town thing day one.
Yeah.
But so from what I've seen, the A class that we've bought most recently, we haven't missed any economic vacancy. I mean, we just remained steady at 92 to 94% occupied.
That's great.
Since Christmas, right? On some of our C class, I mean, we've dropped 20%, in occupancy. It's because probably most of those shouldn't have been there.
Sure.
They were a pulse, just a pulse to keep check a box that it was occupied. They may or may not have been paying rent. Those kind of things. And also too, when there's a new manager in town and they actually enforce the rules, folks are going to leave and not like that. So, so I think it's you're going to have more of that in general on a C class deal than an A class. But that's a general rule of thumb. I mean, the deal we bought in Cleveland, we've only dropped 5% in vacancy since over the past like 60 days, which is amazing for a C class.
That's
I think it'd be
great,
more. But that one that one's been really good. It just depends on the deal and the market, and honestly, you never really know until you get in and actually happen. So, that's part of it, though.
That's right. Yeah.
Yeah. Cool. What's the next slide?
Let's see. A lot of questions we get from newcomers from the single family space, right? They say, "Oh, I need to be pre-approved." Right.
Yeah.
And then we tell them, look, we can pre-qualify you, but we cannot pre-approve you. Well, but I need to be pre-approved in order to buy a property, right? So I understand that, right? On the single family side, that's a normal thing, right? Get me pre-approved and I can go and buy whatever property I want.
Right.
On the multifamily side, the best what you really can do is get pre-qualified so that we look at your personal financial statement, as we call it, and REO schedule, real estate own schedule. And we can determine based on that how much you would be able to borrow based on your personal financial situation, right? But when it comes to the property, we just don't know until someone looks at the property. And even once we look initially at the property, most of the deep underwriting is done at the property level post-application, right? So that's why it's impossible to pre-approve anyone for a deal. It's more to pre-qualify a sponsor.
Right. It's more of a ballpark and a term sheet that you get instead of like an actual rubber stamp. You're good to go. Go buy.
That's right. Yes.
To this max,
so that's only the big difference from single family, where as long as you get an appraisal back for the single family property, you essentially know that you are able to close. Right. With multifamily, there are so many moving pieces, from appraisal to property condition assessment, to crime, to fire, whatever it is. You never really know when to get closer to that closing date that everything is lined up properly.
Right, you've got a little more stress on the
yeah, definitely
when you're under the gun to close these multifamily deals. But but if you've got the right team, then usually you can work through all that. And, good mortgage broker, and I think it's good to reuse folks because one, they know your personal financial statement, so that makes that part of the transaction easier.
Right, yeah.
And if we reuse some of these same lenders, that also makes it easier too.
That's right, yes. So they know you, right? So they know how you performed in the past, right? That's only very helpful.
And our deal in Denton, so we bought a deal, and I mean I can say it now, but it was a D class when we bought it.
Oh,
no one buys a D class, by the way. No one ever does that. Brokers don't sell it. We don't buy it.
That's right. They don't exist.
But being honest, it was a D class, and so I mean that. The reason how we got 80% leverage on that deal, Fannie Mae on that D class, it was really rough. But I mean, I showed up. But it was the second loan I had done with this DUS lender on behalf of Fannie Mae. So that definitely helped. And also, I was there on site to like paint the Shangri-La, how beautiful it's going to be, right? And what we're all going to do. So I think that's very important for deal sponsors, especially first timers. Get out there. When the lender's going to be out there and do their inspection, because you've got to be able to sell this, not just the property, but you and the staff and your plans and dreams and how beautiful it's going to be.
Sure.
You've got to be able to be able to do that.
Sure. That's also one of the big roles we as mortgage brokers have in that segment, right? So we need to paint the picture for the lender and for the lender's underwriter, and ultimately for Fannie and Freddie or whoever is taking over that loan at the end, right? They just cannot go that deep to analyze a deal, right? So they just go on to Google and find, well, crime rate is high, right? Well, then you need to explain why the crime rate in the area might be a little bit high, but these are the things that are being done by that new sponsor to mitigate that crime risk at that property, right? As well as the tenancy changes and so on, right? It's all about telling a story to get to the loan proceeds that you need.
Right. Yeah.
So as a deal sponsor, coming from a mortgage broker standpoint, what do you typically look for in a deal sponsor? So that way it's a very smooth transaction.
Obviously, net worth liquidity is one of the key elements. The next piece, if you do not have it as a first-time sponsor, is to bring in an experienced sponsor, right, who has already done a similar transaction. It's not always necessary, but it's a great help if you can do that. Right. Now, when it comes to a Fannie loan, what you have mentioned before, right, that D-class property, if you did it all by yourself as a first-time deal, you would never be able to do that, right? So you were able to do it because you already had a prior Fannie experience. But even if you didn't, then you could bring in someone. Let's say you found the property, you could have brought in Kenny in order to get the deal still done. So that experience element is absolutely crucial, right? Yep. That the sponsor, that the lender feels comfortable with you. Obviously, if they can look at past transactions you have done that are performing, then it's getting easier every single time you apply for a loan.
Right. Yeah, I mean, so we, and also too, they look at as a first-time sponsor, they look at your resume. Do you have business experience? Do you have real estate experience? They look at those kind of intangible. It's not very black and white. I mean, there's some boxes that are black and white, the net worth and liquidity, right?
Yes.
But
the rest is still kind of a gray zone.
It's a story, right?
Yeah,
so
sure,
that's Anton's job is to sell how great Ronny and I are to the lender, right? That's why you got to lend to these guys, right? So that's something to think about too, is building that resume somehow, some way to get so that it's easier for you to go get your first loan.
That's right, right. And some of that is also that you partner up with someone like Ronny did, right, in a couple of deals. So you gain the experience, you have hands-on experience, and every time you do that, you build up your resume so that once you get into your own deal, where you are the lead, that they already know that you have done it a couple of times.
I think that's important. Like partnering with the right team is really important, especially if you're trying to sponsor your own deal. Don't do it by yourself. Go and reach out to sponsors in the submarkets you want to be in. I mean, I think I say this in every show, but that's so important because you can't do big multifamily deals by yourself.
Right.
It just doesn't happen. So, and then having experts like Anton is absolutely crucial because like the terms we got on our past two deals were incredible, so it's all thanks to him because he works hard for us. That's why you need a mortgage broker instead of going direct to the lender. You need someone that's fighting for you and telling you, telling the lender the story and, selling your team and stuff like that. I think that's really important.
Especially these days when you're finding, the deals that we're looking at are deals that have some kind of story to them, right? There's like the deal we're buying in El Paso tomorrow. I mean, it's, he's at least $100 under rent and without doing much. Yeah. And these, maybe another 140, 150 on the upgrade units under the market. It's partially in a floodplain. So we got to explain all that. And in the buildings, we got elevation certificates. So the buildings are out of the floodplain, the parking lot's in there. So you have all these kind of moving parts, especially on the deals that we're buying now, because if the deals that have a story to them, you're getting a discount on the price for the most part. So our deals, we've got to have a mortgage broker that can sell the vision with us, to these lenders on why this deal is the deal for them to finance our deal.
Yeah.
So
Good.
Jump into like what are some common like multifamily lenders that you work with? Because then there's like a list that you can. There's like a certain list you have for agency. So.
Yes. So one of the beauties again about compared to other commercial loans is that you have HUD loans, which you mentioned, which is really a niche. It takes a long time to get these deals done, usually 6 to 12 months. For a new construction, it can be 15 months. So it's a long time, a lot of upfront cost. But the two main players on the agency side, Fannie and Freddie, are really a unique item that we have on the multifamily side that no other commercial asset has. And they are such a valuable piece to the puzzle for you as a sponsor, right? That you are able to get financing from these two agencies that you will not be able to get from other sources, right? Yes, there are CMBS lenders out there, and that segment actually has grown quite a bit, but the agencies are still the most favorable lenders, I would say.
Right.
Whenever a deal is suitable for an agency loan.
And they're highly competitive against each other, and that's what's helped us borrowers out is the interest rates are kept low, and they're kept low, and then they're non-recourse, and they're trying to outdo each other on loan proceeds. So it's always nice to have two different lenders to play off each other.
Absolutely. Yeah.
Yeah.
Absolutely.
And each lender so Fannie and Freddie, they prefer different, not always different, but sometimes one will like a certain market and one won't, right?
Yes, that's also where a good mortgage broker can be really helpful, right? Like we look at the deal now in Fort Worth that I knew the lender that was originally targeted just doesn't like that area, right? Okay. Because they are more kind of A-class, A-location lender historically. They may go down to B, but once you talk about C-class properties and C-class locations, they're just not the appropriate lender, even though, yes, they're on the list with Fannie and Freddie as an agency lender, right? But you really need to know what is going on behind the scenes, particularly when it comes to Fannie loans, because the Fannie lenders still have a risk portion that they need to keep on their book, right? So they have 20% of that loan they have at risk, right?
Yeah.
So obviously they have to decide in-house whether they want to support the loan or not, even though it's being sold to Fannie and they get all the money back from the initial funding from Fannie. They still have on their balance sheet the 20% of that loan amount that potentially they have to cover, right, if the loan goes sour.
Yeah, right.
So that's why not every lender has the same appetite. Sometimes even if they have an appetite in a market, they may be overextended, right? So if you already have several $100 million in a market, you may just don't want to do it because you've as a percentage of your portfolio, you're just have a kind of too high of a risk in a particular location.
So, like, I think a good example of that is Lubbock, Texas, right?
Yes,
so they went off
right.
of the non-pre-review with Fannie Mae, right?
Yeah.
So your leverage just dropped because Fannie Mae, and I'm speaking for Fannie Mae, so whatever. But from my understanding is Fannie Mae had too much exposure there in Lubbock and thought that there was too much A-class, some kind of units going on, and so they kind of got spooked. So now Fannie Mae, I mean, what kind of leverage can you get in Lubbock today?
Well, you can get 65 on a delegated basis.
Okay.
You may be able to get a little bit higher, but then you have to go back to Fannie and make a good case to get to 70%, maybe all the way up to 75%, right? But it's a battle ultimately, right? It's you go back and forth to find a way to get above the 65 mark.
So what about Freddie though? So is Freddie more competitive there?
Freddie, in these markets, sometimes Freddie is more competitive, particularly if they do not have that much of an exposure. They may be the better solution, right? That is only the case down in Houston, where we see it more and more, right? Houston is still pre-review with Fannie now for a long time.
Right.
But particularly in better locations, we can let Fannie and Freddie compete in that market, right? So that we do not just, where Fannie does not come back and say, well, I think we cap it at 70%. If we tell them, well, but we talk to Freddie and I think they are willing to go with 75%,
Right.
Fannie may be willing to
manage that.
To match
go
that.
higher.
Right.
Yeah. All right. Well, good. Guys, we're going to go to a break, but like, share. Please add some comments so we can get some questions here in here and more questions, and we'll get them answered. Thanks.
The Propelio Academy, an all-in-one education resource for training in wholesales, subject to wraps, short sales, flips, rentals, BRRRR, property management, and more. Go to propelio.com/academy to get your scholarship today. Propelio.com. What does Propelio offer? Lead generating websites, access to true MLS comps, off-market lead lists, and deal alerts. Get them all today at propelio.com.
Welcome back to the Commercial Cash Flow Show. We're talking about multifamily financing. So, Anton, we're talking about pre-review markets in Houston. So, what makes like Fannie or Freddie make it like a pre-review market? Like, what are the factors?
There are a couple of them. Sometimes you do not really know exactly what the thought process behind is. Like Oklahoma has been pre-review for a long time. There it kind of makes sense because it's oil related, oil and gas related. The same applies to Midland and Odessa. And to some extent, that's also the reason in Houston, right? But I think in Houston, one could make the argument that Houston now has a much more diversified economy,
Right.
that it really shouldn't be a pre-review any longer. But I think Fannie is just a little bit more careful to remove it from there. But there are other markets where they actually dropped the pre-review, like in Ohio, right, where they dropped some markets. So they are willing to remove markets from the pre-review once they see that there is enough growth and that the economy is stable. Ultimately, the reason why they put something into pre-review is really out of concern that if you go delegated all the way to 80%, that there is an increased risk of loss, right? So that's why essentially say you need to come back if you go above the 65%.
Right.
Right.
Yeah, for sure. We were looking at a deal in Lubbock, and there's been 2 buyers now that couldn't get the financing, apparently. And so I keep waiting for them to come back to us, right?
Yes,
So they've come back twice so far. And then someone else seems stepping up, and they can't either raise the equity or get the debt that they need to make the deal work. And it's just because Lubbock's just not there right now. I mean, you've got to, maybe 65, 70% leverage is the max you're going to get. So
Right.
you've got to underwrite to that. If you don't, then you're going to lose a lot of hard money that these guys are losing. So.
Yeah, that's right. And so it turns more into unless it's a heavy value add, then it turns more into a cash flow play, longer term cash flow play.
Right.
Which
Those aren't bad.
Which is not bad, right?
Sure.
But obviously your going in price needs to reflect that lower leverage too.
Exactly.
Right.
Yeah. Exactly. So we're holding steady at our low price offer. So.
Yeah, they will come back to you.
Right. Yeah, they will. Well, we're here. We're not going anywhere.
Yeah.
So. Well, good. We got a question from Jeremiah. It says, came in late. What is the best financing terms that y'all have received or tried to receive? So here we go. This is fun. So what's the brag book, Anton?
Well, obviously it depends what kind of loan we talk about, right? On the agency side, most recently, like you mentioned that loan, we came in at sub 4.3% interest rate for a 10-year fixed with 5 years interest only, right? So in the current environment, that's extremely aggressive and it's extremely attractive. On the bridge side, I would say the most favorable loan proceeds that we have seen was 90% of total cost.
Wow.
Right? Bridge lenders, as long as the story is right, can be extremely aggressive.
Sure.
You just have to be very careful there, right? But the bridge lending space really has been expanding dramatically over the last year to 2 years, which allows us to get a little bit of better terms than compared to just 2 years ago.
Right. Yeah, I mean, so I guess some of the ones that we've done recently that were kind of the brag book would be we did an A-class deal where we got 84.4% leverage on the deal, and they're blended. So we had 2 loans on it. We had an initial of Fannie, and then we stacked a second on top through a state. The state of Texas has a loan with the builder on that. So it was a brand new A-class. So that's how we got it. But 84.4%. And the blended interest rate was 3.85 fixed for like 10 years.
Great.
I mean,
Wow.
that's a beautiful thing. But those deals don't come along every day.
Sure.
And it was a special case for that brand new build. The deal, like I said, the deal we're closing tomorrow in El Paso. That's a non-recourse bridge loan. That was at 78% leverage of the purchase and 100% of the rehab.
Yes.
So that was very attractive too. And then length on those bridge loans are the thing that we wanted to make sure in this bridge loan was that we've got 3 years of initial term, and we have 2 one-year extensions, so we can go through any kind of if there's a hiccup
the world
for
falls apart
9 to 18 months, whatever it is, we can go through that if we have to. We don't want to, but if we have to, we have to. So as long as you can build those kind of parachutes in, that's a big deal. But I mean, the interest rates are great on these deals. I mean, I think 5.25% was what we were getting back in 2010. That's one of the first deals I remember us getting. And they've kind of bounced around there. So now we're back in the 4s. The 10-year Treasury, right, is what I watch daily. That really sets kind of a lot of the loans that we get.
Sure. Yeah. So the 10-year Treasury is now just slightly below 2.6%, right? It fluctuates quite a bit, right? In October, November, we were up at almost 3.25, right? And then we dropped to the less than 2.4 just in January, right? So you have pretty big swings in a very short period of time. So sometimes that is also a little bit of luck, right, with these loans, other than Freddie small balance where you can lock in the rate when you apply for the loan. You essentially are at risk for interest rate movements, right? And sometimes you win, sometimes you lose, right? In that case there, it's only was the interest moved into your advantage, right?
Also, too, like on the day you're trying to, lock your rate, you've got different investors on the debt side, beating each other up. So if you've got a newer product or some kind of story to it as well, that can help you shave off a few bips off your interest rate. So it always helps to have folks kind of fighting each other for your loan.
Yes,
so that always helps.
Yeah. Definitely. Now, when it comes to the bridge loans, right, the rate I would say is important, right? But the certainty of execution as well as the post-closing handling is really kind of even more important, right? Do they handle the escrow distribution of the rehab money in-house, right? Or do they securitize the loan and then you have someone across the country who will review your draw requests, right?
And then, or they send out some kind of inspector, and it takes like 2 weeks for them to get out there, and then another. I mean, so you want to.
That's right.
The post-close servicing is huge.
Yes.
That's a big deal to watch out for.
Yeah.
So there's lenders I won't do business with again.
Yes.
And there's lenders I really like because it's as easy as shooting a photo of the work we did, show an invoice and a check that's cleared for the vendor, and then bam, 2 days business later we get a ACH in our account.
Yes.
I mean that's the kind of service we like and what we've been spoiled to on some of our lenders. So that's a big deal is to watch out. Ask how quickly can I get those repair draws, because if it's a month, you've got to pay for it and float that cash that's out for at least however long until you get it back. So that could really affect your cash flow if you don't watch out for that. on that piece. So
Yeah.
you got to watch out for the servicing and the bridge lending is the Wild West. I mean, there's not a lot of regulated about it. So make sure you talk to others who have used them, talk to mortgage brokers that have experience with them, and just know that the costs are going to be a little bit higher to do some of those lending and other costs to do that.
Yeah. Definitely.
So there's lots to keep in mind. So that's why you need a guy like Anton to really be in your corner and know who the good lenders are and who aren't, and all those different aspects that you need to know. But you've got to, again, this is a team sport. We say it, I think, every show, but it's a team sport. So you've got to get your team lined up, and one of them is definitely lending, property management, things like that. You've got to have the team, for sure.
Yeah, definitely.
And any final thoughts, Anton?
Yeah. Thanks for having me here, right? It was really great. Thanks for the invitation. So if you would like to have a copy of the slide, you can send a text to 972-805-1919. That is our corporate number with the text Propelio. And we will send with your email address, and then we will send you the slides.
That's fancy.
Yeah.
That is fancy. Or comment them below. We can do that as well.
Yeah, that too.
Yeah.
And so how can people reach you?
That's the same number,
Okay.
As well as my email address, amattli@peakmff.com. We can put it in the comments too.
Yeah, we'll put that
Do
down
you have
there.
a slide? There's a slide on it.
Yeah,
Right?
there is a slide. Can't see it, but that's.
Let's see. We'll pull it up here so y'all can see.
Yeah,
There you
so these are our contact details. We have a couple of team members. John is also here in Dallas. He actually worked for Freddie SBL. He was one of the core team that built up the Freddie SBL program.
Nice.
So he has a wealth of knowledge when it comes to the Freddie SBL program, which is really ideal for the newbies in that space.
Okay.
Awesome.
Good.
And Kenny, how can people reach you?
So they can reach me at Wolfe with an e-investments.com. We're on Facebook, LinkedIn. We got a YouTube channel. Find us there. Some events that we have coming up is April 27th. We've got a meetup here in Dallas that we do monthly. We've got always bring in a guest speaker that focuses on multifamily. And then the bigger event is June 22nd in Santa Monica, California. We've got the Marriott at the Marina Del Rey. Come out and check us out. We'll be launching that. That website's about to go live, so you can buy tickets and find more information about that here in the next day or two. But come follow us on Facebook or LinkedIn, and you'll be able to see that on there.
Awesome. And best way to reach me, Ronny Phillip, Kingley Acquisitions. You can reach me at my email, ronny@kingleyacquisitions.com. And make sure you send us a friend request, follow us, continue to support us, like our Facebook pages. I also want to thank Propelio.com for hosting the Commercial Cash Flow Show. If you haven't checked out Propelio, the best real estate investing software. They have a lot of different tools for investors, so I definitely recommend signing up for. Y'all have a free trial, right?
Yeah, it's a week long.
Yeah, free trial.
No credit card needed.
And no credit card needed, so really awesome software. And keep the comments flowing, keep the questions flowing. We'll be happy to answer them. And thanks for tuning into this episode of the Commercial Cash Flow Show. We appreciate you. Be sure to like the Propelio Facebook page and also like the Commercial Cash Flow Show page. And see y'all next week. Take care.
Hey.
Propelio TV is sponsored by Noble Mortgage and Investments, Batchkip Tracing, Think Multifamily, CreativeCashflow.com, and Lifeonaire.
Hey everybody, I'm Ryan with Propelio. If you like what you saw, please subscribe. Turn on those notifications and stick around for more. We have tons of content like this all over our channel. So if you want to learn more about real estate investing, stick around, watch Propelio TV, and we'll see you later.